Welcome to Talk Tickers, your shortcut to being well-informed on corporate earnings calls. Today, we're doing a deep dive on the Q3 2025 earnings for Titan America SA, that's ticker TTM, a huge integrated construction material supplier really all over the U.S. East Coast.
And we are jumping right into a really fascinating dynamic on this one. This call, it presented this clear sort of narrative split. You had a slight revenue miss, which was honestly just quickly overshadowed by some exceptional operational performance. And I think for you, the listener, the mission here is to understand why the market just didn't care about that top line. The reaction, that pop in the stock price, it tells you one thing very clearly. In this kind of high rate, uncertain macro environment, investors, they just prioritize margin execution and free cash flow above everything else.
Okay, let's unpack that with the actual number, the core metrics. So revenue for Q3, it came in at $436.8 million. And yes, that did miss the consensus estimate, but by a really tiny fraction, like 0.6%.
A rounding error, really. And let's keep perspective, that is still a very healthy 6.2% year-over-year growth. So they are definitely still growing.
Exactly. But you said it. The real story is what they kept of that revenue.
That's where it gets interesting. The adjusted EPS landed at around 33 cents. That beat the consensus of 31 cents. But more importantly, the adjusted EBITDA, that surged, up 18.3% year over year to $116.7 million.
Wow.
Yeah, I mean, that kind of margin leverage, especially in a pretty slow construction market, that is impressive stuff.
Absolutely. And that margin expansion, that's the signal you really need to be watching. The adjusted EBITDA margin clocked in at 26.7%. I mean, to really grasp how big a deal that is, that's a huge 270 basis point improvement from Q3 of last year.
A massive improvement. And the bottom line, it just followed right along. Net income climbed almost 45% year over year to $57.4 million. This isn't just, a small incremental improvement. They're telling you this is a structural shift.
And management really wanted you to believe it's structural, didn't they?
Oh, they hammered that point home. They were very clear this wasn't just, favorable timing on price versus cost. They claim the foundation for this margin expansion is permanent.
So what are the pillars of that? What are they pointing to?
They laid out four key things. First, a better sales mix, so favoring those higher margin products. Second, just rigorous cost discipline. Third, big gains in logistics efficiencies. And finally, and this is a big one, the fact that their previous capacity investments are finally, generating revenue without adding a ton of new cost.
Okay, so if that structural claim is real, where did this power actually come from? Let's break down the segments. The Florida segment, that seems to still be the crown jewel, right? It delivered $263.3 million in revenue, up over 4%.
Florida is the perfect example of their whole strategy. That region is just being fueled by these huge infrastructure projects and private non-residential construction. And their aggregates performance, the rock business, was super strong there. That's because of the successful capacity ramp up at their Pensuco facility. That plant is basically a margin machine for them now.
And the numbers back that up.
Yeah, Florida's segment adjusted EBITDA alone jumped 16.2% to $81 million.
Okay, and meanwhile, what about the Mid-Atlantic segment? That's faced some headwinds, but it looks like it showed a pretty solid return to growth. Revenue hit $173.5 million, which is a strong 9.4% increase. What was driving that comeback?
Two things, mostly. They said they were finally releasing some major project backlogs that had been stalled earlier in the year. And honestly, a bit of luck. They benefited from much better weather comparisons. Last year's Q3 in that area was just, riddled with hurricane disruptions.
Okay, so let's get into the specific volumes, because that shows where the infrastructure focus is really paying off. Cement volumes up 2.6%, ready mix grew 4.1%, and those aggregates, the ones you mentioned from Pensuco, they surged almost 12%.
And critically, the pricing held up really, really well. Cement pricing was stable, but aggregates pricing actually increased another 3.3% per ton.
But you can't ignore the broader market completely. There was one soft spot, right?
Yeah, and it confirms that broader market struggle. Concrete block volumes, they declined just a little by 0.7%. And that reflects that, that persistent weakness in the residential housing market. Higher interest rates are biting there.
Before we look ahead, we have to talk about the balance sheet. I mean, it's the security blanket for the whole story. They're just operating with incredible financial health. Net debt is only at $268.8 million.
And the key insight there is the leverage ratio. It sits at this exceptionally conservative 0.71 times trailing EBITDA.
Wow, that is low.
It's incredibly low. I mean, to give you some context, a lot of their peers, they operate comfortably between 1.5 and 2.5 times leverage. So that 0.71x level, It's a strategic position. It gives them massive optionality. They can either weather a big downturn or, and this is probably more likely, it gives them significant dry powder for M&A when the cycle turns. Oh, and they also generated about $68 million in free cash flow this quarter alone.
Okay, so that strong balance sheet, it should give them confidence, which makes their guidance revision really interesting. They trimmed the full-year revenue growth outlook down to the 2 to 3% range. If execution was so great, why pull back on the top line?
It seems like just a heavy dose of realism, and it's all tied to the housing market.
Yeah.
Yeah, they mentioned some weather impacts in the first half, but the real reason seemed to be those residential delays that just won't go away. This is basically management admitting they can't fully offset housing weakness just with infrastructure strength.
So is this, genuine realism? Or are they just managing expectations down to set up a future beat? I mean, despite the revenue trim, they confidently said they still expect a modest improvement in EBITDA margins for the full year.
That's the key question. Is it really possible to hold or improve margins if volumes are softening and the macro headwinds are still there?
Right. What are the headwinds exactly?
Well, they're not trivial. Management was very explicit. They don't expect a meaningful rebound in single-family housing until the second half of 2026. So still a ways off. And on top of that, they expect tariffs, which is a non-operational cost, to be about $7.5 to $8 million for the year. And that eats right into profit if you can't offset it.
But the call wasn't just about defense, it was about offense too. They laid out their future, and the big strategic catalyst was this entry into the precast lintel market. That's where the growth story really kicks in, right?
Yeah. This is a huge move for them. It's a move toward true specialty products. For anyone who's not familiar, precast lintels are those structural concrete beams that sit above doors and windows. It's a small component, but it's a very high value one. TTAM has already approved 40 lintel designs, and they're targeting their first manufacturing plant for late 2026 or early 2027.
So why is this such a big deal for them strategically?
It's all about vertical integration and capturing margin. By making the lintel themselves, something they'd normally buy from a third party, TTAM controls the supply chain, they control the quality, and most importantly, they capture those specialty manufacturing margins. We're talking margins that are often, 15 to 20% higher than their normal ready-mix business.
And it's set to scale up right when they expect housing to come back.
Exactly. It's positioned to scale very quickly starting in 2027, which is, perfect timing for that expected residential rebound.
And speaking of future margins, they didn't stop there. They laid down a pretty major marker for 2026. They announced forward price increases effective January 1st, 2026, across all their key product lines.
Yeah, including a really significant $12 per ton increase for cement and $3 per ton for aggregates. These are bold moves. They're designed to protect and expand those margins into next year, no matter what the volume picture looks like. But it also shows you their confidence. They're betting that their position in these high-demand markets, especially with infrastructure modernization, the Sunbelt population boom.
And the data centers, too.
And the extreme demand from data center expansion. You're right, like those massive QTS developments they're supplying in Virginia, they're basically anchored in all the fastest-growing construction segments right now.
So let's talk about how the street processed all this mixed news. That immediate market reaction, the stock rallying 4.6% after hours. It clearly suggests investors cared way more about the margin execution and the strategic story, the lintel integration, than they did about the tiny revenue miss.
It's a classic flight to quality, but within the materials sector. If you look at it in context, TTAM has been significantly outperforming the broader materials ETF, the XLB, for a while now. And that resilience, it just confirms that their integrated model, plus that heavy infrastructure tilt, is protecting them from all the volatility hitting the rest of the U.S. construction sector.
And the analysts seem to agree with that long-term view.
Yeah, the consensus rating is still a firm buy. The average 12-month price target is around $16.70. The whole long-term story here is clear. They're successfully shifting from being a purely cyclical commodity supplier to becoming this infrastructure-anchored platform that strategically layers in these specialty, higher-margin products.
Which brings us to where we analyze the extreme implications of all this data.
Yeah.
This is not financial advice. Now remember, this segment is strictly for educational and entertainment purposes. We are not licensed to provide financial advice, so please consult your own professionals before you act on anything.
Okay, so My outrageous but plausible trade idea. It's derived directly from what management explicitly said about their residential outlook. It's a highly leveraged, calendarized options play tied directly to that 2027 ramp up.
Okay, break that down.
The core idea is to stay short or neutral on the implied volatility of any front month calls because the stock might just grind sideways through 2025. But you aggressively purchase deep out of the money calls that expire in late 2026 or even better in 2027.
So something like the January 2027 $20 calls, I mean, that's way above the current consensus target of $16.70. What's the specific logic for that big deferred bet?
The logic is all about timing synchronization. Management flat out told us the residential market, which is the missing third wheel of their revenue right now, it won't meaningfully turn until the second half of 2026. So this trade is a leveraged bet that TTAM's premium infrastructure business, plus that high-margin lintel ramp-up starting in 2027, will coincide perfectly with the cyclical housing rebound. If you get all three of those growth drivers, infrastructure, specialty products, and residential volume all firing at the same time,
The stock could really take off.
it could launch well past those conservative consensus targets. You're basically buying the leverage of a perfectly timed operational and cyclical recovery.
So to wrap this all up for you, what does this all mean? The key takeaway from this deep dive is pretty clear. Titan America is executing brilliantly on margin expansion. They're doing it through cost discipline and smart strategic investment, especially into that high-margin lintel market. And they're managing the macro headwinds by leaning on strong infrastructure demand and, maybe most importantly, keeping an incredibly low leverage profile. That gives them maximum financial flexibility.
And my final provocative thought for you, the listener, is this. Given the company's success in rolling out their green cement initiatives, they're getting close to 3 to 5% of total production being that low-carbon 1P cement. So the question is, how much additional pricing power does their position in these high-performance, low-carbon solutions add to those big 2026 price increases they announced? Is that $12 per ton cement hike just the industry floor? Or does their early mover advantage in sustainability let them command a green premium on top of it?
A fascinating angle to consider as that whole industry evolves. Thank you for joining us for this deep dive into the Titan America Q3 2025 earnings call. We encourage you to continue exploring the world of earnings calls and stay well informed. We'll talk to you next time.